Imagine locking in a mortgage today and still paying it off in the year 2075. Sounds wild, but the idea of 50-year mortgages is popping up in the US. And depending on who you ask, it's either the solution to our affordability crisis or the start of a whole new problem. Today, we're breaking down what a 50-year mortgage really means for home buyers, affordability, and most importantly, real estate investors. Is this the key to unlocking home ownership or a ticking time bomb for prices and long-term equity? Let's get into it. Hey everyone, it's Alyssa with Bay Property Management Group, and welcome back to the channel. If you follow the housing market, you've probably noticed one major theme. Affordability is at an all-time low. High interest rates, low inventory, and rising home prices have pushed a lot of people out of the market over the past several years. While rates have started to improve, it has done little to solve the broader problem of affordability, and that's why the idea of ultra-long mortgages is back on the table. We're talking 40-year, even 50-year loan terms, common in some other countries, but not something we've embraced here in the US. So what are we actually talking about? A 50-year mortgage is exactly what it sounds like, nearly double the length of a traditional 30-year loan. But here's the catch. Extending the loan doesn't magically make homes cheaper. What it does is spread the payments out over a longer time, meaning lower monthly payments, higher total interest paid, slower equity growth, and a much longer debt horizon. So you may pay less today, but way more over time. But let's talk about the pros first. And yes, there are some. First, and most importantly for many battling affordability, is lower monthly payments. This is a big one. For first-time buyers, especially younger households, a longer loan term could mean the difference between qualifying or not. Relief during a housing crisis. With affordability hitting record lows, some experts argue we need something to help people enter the market. Stretching payments could give short-term breathing room. But stretching loan terms also keeps the American dream alive. Home ownership is a major wealth builder in America. If a longer mortgage is the only way some families can get their foot in the door, that's not nothing. But now for the downside, and honestly, it's a long list. The truth is, it doesn't actually fix affordability. Lower payments don't mean lower prices. In fact, longer loans can actually push prices higher because more buyers can suddenly afford inflated home values. In addition, you pay way more in interest. A 50-year loan could mean tens of thousands more in interest over the life of the mortgage. You're paying for affordability today with a massive price tag tomorrow. It also means slower equity, and in turn, worse wealth building. With mortgages this long, you barely touch the principal for years. If you want to move, refinance, or pool equity, good luck. You'll be stuck in slow motion. Instead of fueling growth, it can create housing stagnation. For example, Japan rolled out 100-year mortgages decades ago, and it didn't solve their affordability challenges either. Prices stayed high, and younger buyers ended up with lifelong debt. Okay, now let's talk about another group in real estate that these changes can affect: investors. Investors could benefit in the short term. If more buyers get priced out, even with longer terms, demand for rentals stays strong. That means stable occupancy, steady rent growth, and less turnover. But higher home prices hurt long-term portfolio growth. If ultra-long mortgages push prices up even further, investors pay more for acquisitions, and cap rates could compress even more. Flippers and buy, renovate, repeat investors, they're not in love with this idea. Slower equity growth and higher prices make value-add strategies more expensive and harder to execute. Early payments go almost entirely toward interest, leaving loan balances high for years. That's a problem for investors who rely on fast equity gains through renovations, cash-out refinances, or resale spreads. At the same time, stretching loan terms can artificially push home prices higher, shrinking the profit margins flippers and other investors need. Institutional investors win the most. That's the real wild card here. Whenever affordability tools prop up prices, big investors with deep pockets tend to swoop in. Think BlackRock, Invitation Homes, and other large portfolios that benefit from housing scarcity. Right now, the 50-year mortgage is still just a discussion, not a standard product. The biggest barrier? Banks don't love the risk, and federal loan programs aren't designed for such extreme loan terms. But with affordability worsening, political pressure rising, and younger generations struggling to buy homes, don't be surprised if we see pilot programs or expanded 40-year loan offerings first. So, is the 50-year mortgage the magic solution? Not exactly. It might help a few buyers squeeze into the market, but it won't fix the underlying problem. We need more housing, not more debt. For investors, this could create opportunities and new challenges depending on how the market responds. If you want to stay ahead of these trends and understand how policy changes affect your rental portfolio, make sure you subscribe, hit that notification bell, and drop a comment below and let us know. Would you sign a 50-year mortgage? Thanks for watching, and we will see you in the next video.